You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everybody. Welcome back to the Infinite Banking Mastery Podcast. Hope this last week has treated you well. Can't believe we're already into the first week of February. Time sure flies. Well, some of you might be out there feeling ready to implement the infinite banking concept. And you are wondering, should I use an index universal life policy to begin the process of becoming my own banker, the process of infinite banking? For those of you who are looking to become your own banker and are hearing a lot about index universal life policies, or IULs for short, I heard a podcast recently from some fellow IBC practitioners who have a podcast. They practice in Canada. Their names are Jason Lowe and Richard Canfield. They do a very good job. They interviewed an attorney named Robert Reichard, who is an experienced litigator and has been dealing with hundreds of lawsuits from clients who have funded millions of dollars into IUL products and then lost tons of money. This attorney has actually been featured in the Wall Street Journal and the USA Today. Now, those clients that he's talking about that has lawsuits for, it sounds like some of them may be premium finance cases where people are getting large bank loans to help supercharge the premium for a certain amount of years. And oftentimes with these types of policies, agents are suggesting or advising that the client, can stop funding the premium at a certain time. And that's where it gets dangerous. Usually the certain time would be around retirement years, right? When you don't want to pay the premium anymore, you want to start taking money out. And that's when it gets dangerous, especially dangerous, I should say, when they are stopping the premium, when at that time, usually you really should be paying more premium than you were paying for your life thus far. This attorney says that the problem is really that IULs have been sensationalized. These products are taught to be super exciting. And when you're newly learning about them, they really are exciting. And they certainly captivated me in the beginning of my career. I ended up owning 6 of these policies. Having just come from a large broker dealer, having been investing money for people right after 2008 and the market crashed down, that's when I came across my previous manager who brought me back into the industry. Because he's saying, what are you doing here? Working in assisted living with all these licenses. And I said, oh, no, I cannot do that anymore. That is too dangerous. I was working with all these advisors and not a single one of us helped anybody not lose roughly 40% of their investments. And so I don't know how I'm going to help people by telling them we're going to reach this goal when really I don't have any idea what's going to happen tomorrow, and neither does anybody else. And then he shared with me the world of IULs, which at the time I was just mesmerized by because it was very exciting to learn of a product that had a 0% floor. So in the next market downturn, you wouldn't lose any money. And then also had a cap that was higher so that you still have the opportunity to earn up to a certain percentage. All sounded super great after that whole catastrophe with 2008 and the huge market crash. And I just thought, yeah, this I can help people with, this I can stand behind. And that's before I fully understood how they worked. As I continued in the industry and learned more how they worked and then learned about infinite banking and whole life, it became obvious to me that they were more dangerous and how you really have to be careful with the funding and really how the guarantees on that contract were just meant to protect the company as opposed to the client when it comes to whole life. Whole life is meant to protect the client. It's designed with guarantees to protect the client, and universal life is designed with guarantees to protect the company because they are turning over the risk to the client, the investment risk. I mean, it definitely does sound pretty great to be able to earn the upside potential of the market without any downside risk. I mean, that's cool. It's only not so great when it's a life insurance policy. And as you get older, now those internal costs are starting to go up. They are basically a ticking time bomb. And I know I've described this structure before, but let me say again that an IUL is built with basically an annual renewing term inside. So an annual renewing term that is paired with a savings account. For those of you who don't have a super strong understanding of term, I'll go ahead and explain that some more. So term insurance is usually what people acquire when they want the least expensive form of coverage. So it allows them to buy a larger death benefit. And people that buy term oftentimes think, well, I only need it for a certain time period. I need it while the kids are young or while we're growing our assets. So common time frames are 10 years, 15 years, 20 years, 30 years, that you would lock the term policy in place with a level premium. So your premium does not go up. It just stays the same for however many years that you lock in that price. But once that term period ends, and now the end of your 20-year term, now it's year 21, most companies allow you to continue the policy. It's just going to go up in price. It will go up in price a lot. So I have clients who receive a letter from the company saying, hey, your term insurance term is up and now this is going to be your price. We're going to go ahead and draft that on your next payment period or your next draft date. And they freak out because it is a lot more than what they've been paying. And then each year thereafter, it continues to go up. So it just keeps going up every year. And the older you are and the closer you get to passing away, just the older you are, the more expensive that term insurance becomes, and it becomes totally unaffordable, at least for most people. Some people who have the term in place and then are uninsurable end up feeling like, well, I have to keep this policy because I can't get another one and I'm already not doing well. So they end up having to spend a lot of money to keep that policy in force. Well, having something like that that's renewing and increasing annually the internal costs is not what you want to have with your life insurance policy, because as you age, the costs are just increasing exponentially into your elderly years. Robert Reichert calls a universal life policy a complicated term insurance policy with a chassis of very expensive riders. And an example that he gave, he said that one of his clients that he was helping, that the cost of insurance on his policy for a year was $16,000 and that the fees and expenses were $94,000. As you get older, they get more and more expensive and totally unaffordable. And so that's just, when you're able to see the cost like that, that's what a universal life policy allows. That's one of the reasons why they created it, is so that they could pull apart and make it more transparent so you could see what's happening behind the scenes, what's happening within that life insurance policy, what are the different costs and where's the growth. And it was all stripped down so you could see each part of the policy and how it's functioning. And with that process, they are turning over, like I said, the investment risk over to you and letting you choose how you'd like the money to grow, or what strategy or what indexes you'd like to follow to grow that money. Whereas for a whole life contract, the insurance company retains the investment risk, the risk of growing your money. And for me, I would much rather turn over that investment risk to the company, let them grow the money, and I'll just take the guarantees and the dividends. Thank you. Take over what you're great at doing, and I'll just sit back and enjoy my guarantees and protections. So yeah, he was giving examples of people paying premiums for, say, 5 years and then being told it's fully funded, when again, how could it be fully funded when the cost continues to increase? And if you're not paying a premium anymore, where are they going to get that increased premium from, or that annual premium to cover that annual increasing term that's inside of the contract? They're going to get it from your cash value. And so he gave an example of someone who believed their policy was fully funded and then went to take their first policy loan and ended up getting a letter from the company saying, hey, you need to send in a $90,000 payment or your policy is going to lapse. And he's just seeing these stories over and over again. It's really sad. The attorney said that he actually expected there would be a downtrend after litigating over 300 cases over a 4-year period of time up until 2022, but he hasn't been seeing a downtrend. In fact, there's just been more and more people buying IULs, and it's becoming even more popular of a product. And so he says, how can consumers be aware and protect themselves? Some red flags that he said you could be aware of. He says people that are, or agents that are recommending you to put 100% of your investment portfolio into an IUL, This is definitely something that advisors and agents are advised and prohibited from doing. They're advised against doing it. It's even become a question on the life insurance application. Are you using retirement funds or qualified money to open this policy? They don't want us giving that advice. Certainly, if that's something you just simply want to do, you just want to move some of your money into life insurance, that is completely up to you and something that we cannot advise for you to do. But he's just saying, people that are saying, oh, close out your 401k or whatever and move it all into this, he thinks that's a warning flag. And it's probably because they're saying, well, this account here, it's very similar to what you're doing and it's just got a floor and you're more protected. But really, it's a scary thing with the increasing costs over your lifetime. Some questions that the attorney suggests you can ask the advisor. One would be, what are you licensed to sell? What licenses do you hold? Or how do you get paid on this product versus another product? Now, I am fully licensed to help people in any area. I have a securities license. I can help people in the market. I can help people with annuities, life, disability, long-term care. I can help people in lots of different areas. And so I just find that from all I've learned in all these years, that this is just really the most powerful concept and something I think all people should learn and know, even if they can't do it or aren't sure they're going to want to participate or become their own banker. I just think it's a powerful enough thing that they should learn about it and have that option. I think it's foundational place to house money. So you have something that you can count on, something guaranteed, something that will be there when you hit your retirement years, as opposed to completely at the whims of the market, ups and downs. Now, certainly, if you just are drawn to that unlimited potential for growth, like you can have in the stock market, and you're not so worried about losing money or the downturns or a 50% crash in the market, then by all means, you should do what's comfortable to you. This is just something I love to teach. Out of all the things that I help people with, this is my favorite thing to teach and to help people understand as a foundational asset and place to house your money, place to store your wealth, store your cash, where you're going to have that guaranteed growth and guaranteed protection for your family. I actually don't consider you being truly diversified unless you have some money that truly works, is able to grow regardless of market upswings and downswings. I think if you have, no matter how diversified you are in the market, that having all your funds in the market is definitely not diversified, because everything is within the stock market, whether stocks or bonds. In 2008, everything went down. It didn't really matter what you were holding. And so I feel like this is a true way to be able to diversify and protect a portion of your assets. Another thing you should watch out for that this attorney mentioned was actually an agent in Washington, my state, who was encouraging clients to buy IULs from them and then take policy loans to buy a second IUL. This is definitely something that's not recommended, and the insurance companies definitely don't like it. That's a question on the application as well. Will you be using funds from a policy to fund another policy? And I wouldn't want you to start something that's unaffordable. You don't want to start a second policy and then be struggling to afford them going forward. And you certainly don't want to be using one policy to fund a second policy. That's just not a great way to build your banking system. Another thing this attorney has seen is agents recommending people to go out and get a home equity loan and then use it to fund your IUL premiums. And that, of course, that's not allowed by any carrier. Agents, though, they're doing it over and over. This certainly would be a problem if interest rates start to rise like they have been. People could lose their house, their investment, or what they think of as an investment, because remember, life insurance is not an investment, it's an asset. And also they could lose the coverage or the protection for their family. How truly terrible to lose your house and the fund that you were planning on using in retirement and the death benefit that was meant to protect your family. Now, certainly if you already have a HELOC and you have a whole life policy and you're having a rough year or something, and you understand the ramifications, what is going to happen when you take a policy or take a HELOC, money from the HELOC, and then use it to fund your policy. I don't think that's a terrible thing. I think it's okay as long as you understand what you're doing and that the interest is going to increase on your HELOC and that it's all affordable. And it is possible to turn around and use your life insurance policy to pay off that HELOC loan. It's not recommended, it's not advised by any insurance company to have agents out there telling people, go out and get a huge HELOC, and then we're going to use all that money to fund into life insurance. It could certainly be dangerous in an increasing interest rate market. And oftentimes people aren't considering how they're going to be able to afford the increasing HELOC payment. This is actually one of the reasons that now there is a new constraint when starting a whole life policy where they are looking at your income and only allowing a certain percentage of your income to be funded into a whole life policy or any life insurance policy, because people were doing this on a large scale and people were funding really large premiums as compared to their income. And so the insurance industry put a kibosh to that. They said, sorry, no, you cannot continue to put in really large premiums. How does that make sense? When your income is only this much, we know that you're getting it from somewhere else that you're not supposed to be, or at least in their viewpoint. And so that's one of the reasons we have this new constraint. A real bummer, actually. Apparently, there are also some agents out there recommending IULs as the first thing a client should do. That's an irrevocable life insurance trust. And then they're setting up a trustee who does not own the policy or not the beneficiary. And then they're trying to illustrate policy loans being pulled out for that policy owner later down in life. But you can't do that. You can't have it into this irrevocable trust and then have the person, the grantor, the policy owner who initially opened the policy pay out distributions to that person, because now the trust owns the policy. According to Robert Reichert, the attorney, whole life insurance is a complex product built by actuaries, but actually is a very straightforward product, whereas IULs have too many bad surprises in them. There are, unfortunately, lots of people out on TikTok and YouTube and social media selling IULs and talking about life insurance, and that work in multi-level marketing businesses, which actually is even worse in my opinion. Unfortunately, people who join these types of companies as agents, these multi-level marketing agents for life insurance, they usually don't know a darn thing about what they're selling or what they're helping people with. And oftentimes their uplines don't know either. This is a super high turnover industry, and that before you know it, they're just out of business altogether. When I started in life insurance, I actually started off in one of these multi-level marketing structure type businesses with Primerica, who had a multi-level marketing style where you build a team and all of that, and you go out and help people. Their whole thing was buy term insurance and invest the difference. That's where I started. And at the time, I did learn about life insurance, about term insurance, but that's really all that I really learned. And then as I quickly learned that nobody wanted to talk about dying, I went out and got licensed to help people with their retirement accounts and investment accounts, which they had a very, very limited selection of things, like basically 3 funds that you could invest in with that company. I read everything, I learned everything I could, and then I talked to my uplines, I called the company, and nobody could answer any of my questions. And I'm like, wow, how come I can't ask my upline, or how come the agent service line can't help me or answer my questions? Certainly lost a lot of confidence in helping people with those products, thinking, does anybody really know how anything works? Or is anybody here able to answer any of my questions? That seemed really crazy to me. So I definitely have firsthand experience working in one of these companies and realizing how little my team or my customer service rep for agents really knew about the products and how to help me help clients. And I had been in the business for about 7 years before I even realized or really learned universal life, what was going on, how the products worked, and then learned whole life. So it takes a long time, and a lot of people aren't even in the business that long before you understand how things work and really learn about it. And again, it's just a really high turnover business. So some people don't make it long enough to really even get a chance to learn how things work correctly. Well, I hope that this was useful information for you while you're out there trying to figure it all out. And if you are trying to figure it out, I would suggest connecting with an IBC practitioner from the Nelson Nash Institute who has been studying this day in and day out for years. In my case, over 13 years. I would work with a practitioner you can trust, someone you like, someone that you feel is looking out for your best interest, and continue your learning from there. I can tell you also that we would all like you to have read Becoming Your Own Banker by Nelson Nash before we go into teaching you the concept. This will help you with a foundational understanding that we can then build on. But simply trying to piece it all together yourself by means of different social media channels or videos is more likely to confuse you, and also is a place where you can get bad or wrong information. And companies, insurance companies, are not the ones teaching agents how to do this. So calling a company and asking for help with infinite banking or an infinite banking policy, you aren't likely to get someone who knows what you're talking about, or if you do, the policy is not likely to be designed well. And the company probably won't even know what you're talking about, depending on who you get on the phone. So if you're feeling ready and you would like to partner with me as your coach, feel free to reach out to me at valerie@alphaomegawealth.com. I would love to meet you and learn how I can help you. Thank you so much for listening. I hope you have a great week. Take care.
This is thepodcastfactory.com.